Okay, good morning all. Thank you for joining us. My name is Lewis Manson, producer at IMN, and I am very excited to welcome you all to IMN's first virtual investors conference on trade receivables. Firstly, I would like to extend a very big thank you to all of our conference sponsors: Baker McKenzie, European Data Warehouse, Mayer Brown, Societe Generale, and UniCredit, and panel supporter Demica. All of whom have lent their wonderful expertise and expert speakers to help shape this conference alongside our advisory board. And without further ado, I would now like to hand it over to the moderator, Dipesh Patel, Editorial Director from Trade Finance Global. Over to you, Dipesh.
Thanks, Lewis. Good morning, good afternoon, good evening. Welcome to the first opening panel session of the IMN Virtual Investors Conference on Trade Receivables 2020. My name is Dipesh Patel, editor at Trade Finance Global and host of the podcast Trade Finance Talks. The past decade or so has accelerated conversations around the attractiveness of trade receivables as an asset class. Given the short-term self-liquidating nature of trade finance, coupled with the relatively low default rates, any mechanisms and structures allowing for trade assets to be sold down into the market and opened up to institutional investors can only be a good thing. Access to finance remains a top issue for corporates and MSMEs alike, particularly in emerging and developing economies. Can portfolio securitizations be the key, or should we double down on this strong yielding asset class in an era of the new normal? Today, I'm delighted to be joined by a top-class panel of experts in trade receivables securitization. We'll be assessing the role that securitization can play in trade receivables, including the opportunities, big challenges, current and future outlook. Given the current market dynamics due to the COVID-19 pandemic, the increasing trade finance gap, which is set to double in the next few years, regulatory changes in the market, and the rise of alternative non-bank lenders, there's a lot to discuss today. So without further ado, I'd like to introduce my panel: Robert Plen, Head of Capital Markets at GE Capital; Jerome Farges, Head of Corporate Securitization at Societe Generale; Stephen Holland, Managing Director at Greensill Capital; and Jeremy Levy, Partner at Baker McKenzie. So to start off with, quick elevator pitch, so in no more than 60 seconds, who are you, where are you from, and what do you do? Robert, over to you.
Sure. I'm the head of capital markets at General Electric. Largely, my role is to deal with our receivables programs. We have a number of them in various jurisdictions, which I'll talk about in a bit. Before that, I ran structured finance at Lloyd's and ING Bank, and before that, I was a partner at a U.S. law firm.
Thanks, Robert. Jerome?
Yes, good morning. So my name is Jerome Farges. I am heading the corporate and trade receivables securitization franchise at SocGen. So we've got a team based in Europe, in the US, and in Asia Pacific, and I'm myself based in Paris. So we've got a global coverage, and I've been in that business for now more than 20 years.
Thank you. Stephen.
Hi, good morning, everybody. Thanks. I'm Steve Holland, Managing Director at Greensill, responsibility for capital markets and distribution of trade finance and supply chain finance assets into the fixed income investor base. A quick introduction to Greensill. We're a leading fintech, accelerating cash to businesses and people in a manner that's faster, cheaper, and hopefully fairer to existing alternatives. We have advanced technologies that have allowed Greensill to remove some of the barriers of the access to capital and disrupted some of the traditional working capital financing markets. Our purpose-built platforms allow us to deliver at speed, various data-driven solutions for our corporate customers, whilst at the same time generating attractive asset class for the institutional investor market. On a daily basis, we generate approximately 50 trade finance or working capital notes that are distributed into the markets, making us one of the leading generators of bonds in Europe by number of ISINs. And finally, today, we partner with over 100 institutional investors, including banks, asset managers, and funds, to provide approximately 160 billion of financing to more than 10 million customers in over 175 countries. Thank you.
Thank you. And Jeremy, over to you.
Hi, everyone. Thanks, Dipesh. And good morning, everyone. Hope everyone's well. My name is Jeremy Levy. I'm a partner at Baker McKenzie, the global law firm. I advise clients on securitizations and other forms of receivables financing. Given our international scope, we have offices all over the place. I tend to focus a fair bit on multi-jurisdictional trade receivables deals and have a very keen interest in this space.
Thanks, Jeremy. So we'll get started onto the main panel discussion now, perhaps with a bit of a market overview on securitizations. Robert, from a GE Capital perspective, what are the main types of securitization and receivables finance programs available to corporate customers? And could you give an overview of their advantages, i.e. why would a corporate securitize portion of their receivables book?
Sure. So I think generally, most corporates would use the securitization of the receivables book as a funding alternative, sometimes for risk transfer. But largely what you can see is, particularly if you're sort of a low investment grade or lower company, you can obviously take your pool of receivables and structure them up and create a stronger credit profile than your own unsecured debt profile. Therefore, you can get funding at a cheaper rate than you normally would if you were just issuing debt. At GE, fortunately, we're such a large company and have such a industrial and geographical spread. We run a number of programs, and they're kind of all examples of what you can do. So we run a very large U.S. program that's over $2 billion in funding. That is pretty much a pure funding play for us. We can raise debt off the back of that, probably a good 40 or 50 basis points cheaper than our unsecured debt, and that debt, as we've seen in the pandemic, remains stable in terms of its cost, whereas our bonds, with the pandemic, there was quite a lot of volatility in the funding costs there. We have a similar program, an international program that covers our international receivables also for funding. And then we have another program where it's effectively a securitization, but it's a risk transfer program as well. So we don't just obtain funding on the senior part, we actually transfer effectively the entire risk on the portfolio to a third-party bank. The other types of programs we have that are not securitization related, but involve receivables financing, is we run straight factoring programs. So if we have excess concentrations from our securitizations, we'll sell those to the market, or sometimes those exposures may be too big for the securitizations given the concentration limits in them. So we tend to run those side by side, that factoring program, with our securitization programs. And then we also run a customer-driven funding platform where we effectively will offer customers long-term deferred payments, so effectively long-term receivables, and we will then sell those to banks or other investors. And we do that because it's basically a form of vendor financing. And unlike the securitization and factoring, we actually have the customer engage with the investor, and the customer often pays the funding cost associated with that. So we use receivables technology, but we treat that as a vendor financing program. And then finally, on the other side, we ran a supplier financing program out of GE Capital, but we've exited that business. We sold it to MUFG about a year and a half ago, really because the company didn't feel it was a good use of its balance sheet to effectively be funding our suppliers. So we transferred that to the market. So as you can see, for us, it's really, and for most corporates, it's a combination of funding and risk transfer. And depending upon what you're looking for, you can use any one of those combinations of programs.
Thanks, Robert. What's your perspective, Jerome? What role can securitization play in helping corporate treasurers meet their financial objectives?
Thanks, Deepak. I think Robert gave a pretty broad explanation of all the reasons why you you can go to securitization. I mean, obviously, just to recap, I mean, there is a matter of funding diversification. That's for sure, because it's asset backed, so you're not cannibalizing your signature using this type of solution. It's also about optimization. So competitive cost is something also that is systematically targeted in the context of securitization. I think there is also one component that is underestimated sometimes. It's the huge and massive side benefits that you can benefit from through securitization, because it's about data, streamlining, analyzing performance, and that's pretty much all treasurers need to evaluate the performance of their working capital at a regional or global level. So that's a huge plus. It's also a matter of controlling the organization because it's centralized. Specifically on the KPIs, I think securitization can also provide, and more is providing off-balance sheet treatment for some of our clients, with the consequence it has on the improvement, typically on return on capital employed, or this type of important KPIs for their communication. But I think it was also mentioned by Robert, but I want to insist on one specific feature. We are no opportunistic teams. I mean, the purpose of securitization is to provide our clients through medium-term or long-term partnerships with the benefit of securitization. And so resilience is a very important topic. And I'm glad to say that you know that a lot of products are a bit at risk at the moment, given around the Basel topic, because there has been a lot of uncertainties about equity requirements, in particular for banks. For securitization and trade receivable securitization, we are done. And I think it was a bit of a concern some months or years ago, because we were seeing the regulation progressively discussed. It has been implemented, so we have been slightly impacted, but globally it's still extremely efficient. And the most important, we have killed uncertainties. So we now are able to deploy structure that we know will, from a regulatory perspective, last for long, which is also something that is absolutely essential for corporate treasurers, because if you want that solution to be diversifying and so on, you need to make sure it resists over time. So we got this regulatory clearance, let's say, plus the big tests through the COVID, where we'll come to that. But so resilience is very important. It's a true long-term alternative to raise capital.
Thanks very much, Jerome. I guess, Jeremy, both from a capital and accounting treatment perspective, what are the benefits of true sale traditional securitization from an originator bank and capital markets perspective?
I think it kind of ties in with what Robert and Jerome were saying. There are various motivations that market participants will have, and various factors that they'll be taking into consideration. And a key part of those, particularly on the originator side, is whether they're seeking off-balance sheet treatment or not. And for those that are, securitization is a very attractive proposition if structured properly. And the receivables are taken off the balance sheet of the seller, and really the risk is held by the investors. And there are various structural features that will be built in as a result. So it won't be suitable for all originators. It will depend on their particular accounting treatment. It may depend on the governing law of the relevant receivables, exactly how you would structure the sale. But certainly the tools are out there. And there's interest then on the investor and capital market side. Very much a kind of key feature and something that's very important to the investors is really how do they want to hold this risk. And as Jerome mentioned, the kind of regulatory uncertainty has certainly been reduced with the kind of recent coming into force of the securitization regulation. And a well-structured securitization can give very good capital treatment for banks, particularly if an STS label is obtained. So for those that are seeking that treatment, it will be very important to structure a deal in the right way to make sure that it's ticking all the boxes. But I think the key point is that there are a range of different market participants. So for most originators, depending on their motivations, there will be funders and investors that they can partner with to structure a proper deal that ticks all the boxes.
Thanks, Jeremy. And I guess now leading to the holy grail here, which is to attract more finance into the self-liquidating trade receivables market. Steve, what are the benefits of selling down and distributing these securitized assets into capital markets?
Well, thanks, Dipesh. And it follows on quite nicely from Jeremy's points. One of the key aspects here is how you deliver these assets to a fixed income investor base. The assets need to look and feel similar to the existing asset classes that they're used to buying today. Adding in the fixed income investor base brings in new liquidity to the trade finance market, which perhaps hasn't been accessed or available in this scale previously. So when you increase liquidity, you increase market participants and investors, all of these help to build a much more broader and better understood asset class. And in essence, this is a new corporate credit asset class that we're bringing to an investor base. This in itself is a great result for corporates, as they can access a more varied pool of funding for the whole of their supply chain, not perhaps just their top tier suppliers, which in turn creates a really awesome asset class based around corporate credit for a wider investor community. Again, from an investor's perspective, trade finance assets give asset managers access to a very large and varied corporate credit base. It gives size, it enables them to buy assets that have a more competitive yield compared to traditional and existing corporate bonds, basically because it's generated from trade finance and working capital. So I think in summary, opening up trade finance and working capital assets through securitization and note issuance into a wider investor base gives corporates the ability to grow their finance and supply chain finance programs organically across the whole supply chain, not just through their top tier suppliers, without the limitation of single financier corporate credit limits. And from an investor standpoint, I think that when you look at this asset class as an investor, you have access to a new, diverse and scalable range of assets that they can incorporate into all of their various fund strategies, from IG to non-IG and so on.
Thanks, Steve. Jerome, what role can securitization play introducing various tranches and notes in relatively illiquid trade and receivables assets, particularly given, as you mentioned before, the recent securitization regulation framework? Can it ultimately lead to lowering down the cost of finance or unlocking balance sheet value for corporates?
Yeah, absolutely. And I think Stephen is perfectly right. I mean, and that's because, by definition, trade receivables are by nature illiquid assets. It's short term. It presents different characteristics from one sector to the others. It's basically arriving from specific sales contracts or servicing contracts. So with some variety from a legal perspective. So you need to have, in the first place, experts. So it can be banks, but not only, it can be also factors, alternative funds providers, aggregating these assets. And in front of that, you've got investors. So it may be banks, investors in general, alternative investors, for Convergence treasurers, money market funds, that are looking for simplicity and I think a clear definition of the risk and a simple way to analyze the exposure they are absorbing. So they need something pretty much standardized. And the link between these illiquid assets and the requirement of the investors in order to be able to provide more liquidity to the trade finance world can definitely be securitization, because that's what securitization do. I mean, repackage, analyze, streamline, and make sure that we can deliver various type of instruments that would be convenient to a variety of investors. It can be deposits, it can be notes, it can be a lot of products actually that investors will be keen to invest in. So that's definitely that's something. And by doing so, you also help the access to funds that are available, because we all know that trade receivables, again, at the occasion of each crisis, demonstrate that they are an extremely good asset class. I mean, they are resilient, they are strong in terms of performance, and that's what we do. So I believe the techniques, the securitization techniques in general, not securitization only, by the way, but the techniques around securitization are part of the package of tools that the market should use to facilitate that.
Very interesting, particularly with respect to the COVID pandemic. So we'll now go on to the next session on market and pandemic induced trends. And Jeremy, from your perspective, how have receivables transactions fared as a result of the pandemic, given that originators have most likely seen various short-term measures introduced? We've seen payment holidays, potential breach of covenants and undertakings, obligor defaults. What are the trends you've seen?
So I'd say receivables transactions have actually dealt very well with the crisis. I mean, I think certainly in the early days of lockdown, the word unprecedented featured a fair bit. And certainly when people were structuring deals, no one was anticipating a situation where vast areas of business would just shut down entirely. And the way that the market dealt with that, though, was generally by kind of having grown-up conversations. And Jerome mentioned the word resilience, and that was really demonstrated and continues to be. So investors of all types, in my experience, took a long-term view and looked at businesses and how they were likely to continue post-pandemic, and really quickly got to grips with what was going on. So for some transactions, that would involve pretty straightforward waivers of certain ratios and things like that. And obviously fewer receivables actually kind of going through the transaction for a period. But for others, actually, just because of the way the transactions are set up, the requirements were far more detailed than that. So on certain transactions, it was necessary to do amendments across multiple jurisdictions with all the formalities that entails, checking that kind of extending payment terms would comply with local laws, notarizing if required. But that was all done in a spirit of cooperation and really understanding that the market had to help participants through this crisis. And I think in doing so, what that demonstrated to originators is that receivables finance and securitization as a tool really is a way of working with their businesses. And a concern that originators often have is, well, look, we want the access to financing, but how does it impact on our ability to kind of interact with our customers? And by acting so promptly, investors and the market, I think, have given originators assurance that actually, if originators want to be reaching out to their customers and helping their customers with payments and things like that, that actually having a securitization or other receivables finance in place is not going to be a bar for that. So far, I think the market has done really well, and hopefully it will continue to do so.
Thanks, Jeremy. Steve, what's your view? How has this asset class fared in terms of credit spreads and pricing?
Yeah, good question. And first of all, I'd like to echo many of the points that Jeremy and Jerome have made around the resilience of the asset class. We've certainly seen a strength across the class as a whole. So that would be my first point. I think that so far this year, we've seen quite resilient and stable, if not slightly upward tilting asset flows. In February and March, when we started to see the COVID pandemic hit and put pressure on markets, at Greensill, we certainly saw an increase in asset flows within our programs as some of the more traditional funding lines retreated from the market somewhat. These flows have now stabilized, albeit, as I mentioned, we're probably at a slightly higher level now, and I think that trend is going to carry on as we start to see trade and industry recover. So we would expect to see more asset flows, more supply chain finance, trade receivables coming through the system and the programs, and they will grow. I think when we talk about pricing and cost of funding, in line with really the corporate credit markets, because let's face it, supply chain finance and trade finance typically is pegged to, or certainly referenced against, a corporate bond equivalent, or certainly corporate bonds in the market space. So as we saw the corporate bond world gap out in February and March time at the end of Q1, as the COVID crisis really started to impact the financial markets. So we did see some programs have an increase in their generic cost of funding as investors, had to, deal with their own internal liquidity squeezes, but also as they were able to invest in other asset classes or other assets with a higher yield. So that had a knock-on effect of also causing cost of funds in the trade finance space to be more expensive for independent investors. But these costs of funds, very much like with the flow and liquidity squeeze, has really stabilized. An example of that would be if you're in the non-investment grade space around the start of the year, that went from an index of kind of 500-600 over LIBOR to somewhere well north of 10. That has really come back much more in line with where we started the year. And I think that's also true for trade finance and supply chain finance programs that we run. Only some of them were impacted by the cost of fund increases, but those that were have certainly come back into line with the rest of the wider credit spreads. But I think that from a Greensill perspective, again, the thing that helped us to navigate through the market squeeze and the liquidity squeezes that we saw was in having a very diverse pool of funding avenues, where we're able to fund all of our existing programs through the pandemic crisis using third-party investors, funds, balance sheet, and bank to help us navigate those waters. So I think that really indicates and demonstrates the importance of having a wide array of investors, opening up the trade finance space and supply chain finance to fixed income markets, asset managers, and the like.
Thanks, Steve. Jerome, how has the market fared in terms of protecting itself? And also, can you explain the role of credit insurance market in terms of trade and receivable securitizations and how their appetite might have changed as a result of the pandemic?
Sure. So clearly, I was mentioning that we definitely view securitization programs as long-term partnerships. So for first thing, I mean, I'm very glad to say that during the pandemic, we have not stopped any transaction at our level. So we've got a fairly big book because it's in the region of 10 billion of outstanding, which means between 80 and 100 billion of sales purchased every year. So that's fairly massive. And we have indeed observed different evolutions depending on the sectors and the geographies. Some sectors have been picking up, actually. Typically telecom and IT and so on was more up. And some other sectors were more impacted by the confinement in particular. Typically construction in Europe, not the same case in the US. But also commodities, for example, have been tapped a lot simply because it was a combination of the pandemic itself, so the volumes and price effects. So very different and difficult to analyze. Globally, we are real economy, so we are reflective and we are mirroring what happens in the real economy because trade receivables are very, very basic assets fundamentally. So the volumes, we need to distinguish probably between the volumes that are probably down in the real economy and the fact that we have compensated that a bit because this type of products, as Stephen was mentioning, was more attractive during this period because we are contracyclical somehow in the way because we provide more secured solutions and that's a smart way to deploy liquidity when difficult times occur. So about the resistance of the chain, it's a chain. So what was very important for us is to make sure that from the originator, so it can be essentially the corporates issuing the receivables to the banks, alternative funders, and to the investors, things were under control from a risk perspective. So the first thing is that indeed the originators have adapted, as they always do. They have reviewed their underwriting policies. They have probably sometimes cut some lines, shortened some payment terms in order to adapt to the situation. So they did the first job in the first place. And then indeed, there are more and more securitization programs backed by credit insurance. So they played a big role also in giving some insight, some proactive views on the evolution of the credit risk. It has helped also the underwriters at corporate level to take a view. It has also secured and comforted the investors and the banks about the fact that things were under control. So I would say that you remember some years ago during one of the securitization crisis, I mean, the problem was pretty much subprime and so on. It was pretty much focused around the problems around origination. And I think the beauty of trade receivables is that it's real economy, it's a real transfer of goods and services. And that's where we make the difference, because the full chain, so originators, credit insurance companies when they are involved, and bankers and financiers are there to play their role and to protect also the exposures at the end.
Thanks, Jerome, and great to understand how all those different players within the chain interact with one another. Robert, from of the corporate trade and receivables programs you mentioned at the start of this panel session, how have they been affected by the pandemic from your G Capital perspective in terms of pricing, restructural programs, and also reorganizing equity in mezz and junior debt?
Sure. So I guess I'd echo what the panelists have said, in particular Jeremy, that the market has responded to challenges, I think, in a very productive manner. Frankly, more productive than I thought we were going to see when it all started unfolding. But I think for GE, it's kind of you have to look at it almost industry by industry, because I think the one place that we were kind of not shocked, but just I think everybody unexpected was how industrial specific the pandemic became. And so, for instance, our aviation business, whenever we negotiated with banks on the securitizations, you had concentration limits and concerns maybe on certain names. And you dealt with that with concentration limits. But when the whole industry gets impacted in the course of about a month, you kind of go into, I wouldn't say panic mode, but you're scrambling. And so the aviation impact, for our business, I'll talk about that in a bit, but it was massive, it was fast, and it was unexpected. Our power and renewables business is kind of, just went through the crisis. There was a slow up in things, and there were supply issues and things like that. We couldn't get people into service plants in particular countries because of quarantine restrictions and things like that. But they managed to come through pretty unscathed. And our healthcare business was kind of a hybrid of the two, I'd say. Generally, it did well in certain areas. We make ventilators, so that business was booming. We had a lot of U.S. government exposure. Everybody was happy to take that. But then a lot of the elective surgeries stopped, and so you saw, a tick up in defaults and delinquencies as a result of that. So it was really, sort of a different situation for each asset class. I think in terms of volumes, generally the businesses are operating at about the same volume. The aviation stuff, as you can imagine, is down. And we were already dealing with deliveries of engines on the MAX before the crisis hit, because we provide the engines for that plane. So that created issues. But then clearly just, airlines have been stopping orders or slowing down payments and the whole bit. And aviation is a big percentage, particularly of one of our U.S. programs. And so we really needed to scramble to, effectively just adjust the program to account for things like longer payment terms and deferred payments. And our commercial guys were finding it. This was what was kind of interesting was, usually your securitization just ticks along. It's business as usual. And now all of a sudden, our commercial guys were coming back to us saying, hey, we need to change the terms of all of these receivables we've sold. And, that normally doesn't happen. And we need to keep the business going. So we had to go through quite a big effort with our banking group to, one, explain what was going on, two, get some waivers and increase buckets for certain types of assets. And basically we came to an agreement where we put in a bit more credit enhancement into our program. And as a result of that, we got a lot more flexibility that allowed us to deal with a lot of things we were seeing, particularly in the aviation sector. On the pricing side, it was kind of interesting because we were right in the middle of refinancing one of our programs, our global program. Literally, if we closed it 3 weeks earlier, we probably would have saved 40 or 50 basis points. But it blew up right as we were in the middle of renegotiating. And, frankly, it was interesting how the banks reacted. One or two pulled back, not because they didn't like the program, but all of a sudden they were getting drawn on their liquidity lines. They were effectively rationing liquidity within the bank, and some of them were opportunistic, and they were looking for the best price they could get, and that didn't go well from a relationship perspective longer term. Ironically, some of those banks are now coming back, have dropped their pricing massively and trying to get back into our programs. But what you could see, what was interesting, is we were also refinancing our unsecured debt, some of our big revolver lines at the exact same time. And again, sort of what the panel's been saying is we saw much more volatility on the pricing of refinancing the unsecured debt than we did on the securitization. So even though everything went up, the percentage of increase was much lower on the securitization side than it was on the unsecured debt side. So generally, I think we were happy with the outcome. As everybody said, it is, it's a resilient product. But again, when you get entire industries hit very fast, it sort of, it takes you back a bit. And the last thing I'd say is where we really saw value was in the commitments we had on the securitizations, because clearly what was going on the factoring side, where effectively we don't have committed lines on that. We sell that every month or every quarter as the volumes come in, and there's no commitments there. So we saw lots of banks pulling back again, particularly when we were trying to sell aviation assets. And at the same time that this was all going on, our customers were out in the market trying to suck up every bit of liquidity they could. If they were an airline or an aircraft manufacturer, we were effectively competing with them because we were trying to sell their names into the market. So it was an interesting dynamic. And while there continued to be appetite, I think we definitely saw a number of players pause, in the aviation sector, as you would expect, given what's been going on. So it all held up, but it was interesting and not without its trials and tribulations.
Yeah, really interesting perspective, and what a time to refinance. I guess let's talk about the government-led initiatives, and perhaps Steve, I'm going to ask you a question. We've seen a number of initiatives around the world from governments to keep economies open, as we've mentioned several times, by deferring payments, adjusting obligations, the right through to providing backstops from private credit insurers. How's this worked, and do governments understand how they can fit into the trade finance market as a whole?
I would say it's been a bit of a mixed bag, to be honest, certainly from a trade finance and supply chain finance perspective. I think all the government's intentions have been to support industry and support trade, and so the sentiment is well placed. At Greensill, we were one of the first, if not the first fintech to be approved by UK government's CL Bills programme. And we continue to work with the British Business Bank today on various deals. But it's not been the same level of success across the globe. And we've certainly been talking to lots of different governments around the same subject matter. And one lesson that I'd say we've learned as we look to replicate what we did in the UK and what we've done on CL Bills and the British Business Bank is that governments around the globe have been, when they set up these structures and the support mechanisms, it's traditionally been around more standardized corporate credit. So when you think about the assets that they would accept as part of their support programs, it's been around standard bonds or issuance from corporate X. Whereas when you think about the supply chain finance or the trade finance assets that we generate within our industry, because it's a new asset class, it isn't quite the same and it's slightly different. It didn't fit in those boxes from a technicality standpoint. So whilst the sentiment from government and from a traditional standpoint was working, I think that the ability to access that readily from a supply chain finance or trade finance perspective wasn't quite so easy. So that meant that the bond issuers could go and facilitate and easily access those schemes, whilst trade finance, new programs, new issuance, new structures didn't quite work. And I would probably argue that trade finance assets and funding is exactly what this was set up to do. When the government is there trying to fix industry, flow of liquidity through the markets, you're trying to inject cash directly into the heart of the economy. So directly into the heart of the supply chains and the trade finance networks. And you do that by helping to fund supply chain and trade finance programs that the likes of the panel and we have been doing for a number of years. So I would argue that trade finance and supply chain finance derived assets inject cash directly where you need it. And that helps the heart of the economy and industry to get back on its feet and give it the support that it needs. So overarching summary here is degrees of success. I think as a whole, they have worked in the standard way, but I think as governments look to potentially future issues or liquidity drains, we should be looking more to help educate and bring them in line with trade finance and supply chain finance programs that really does get cash straight into the heart of the matter.
Thank you very much, Steve. And I guess we'll now take a bit of a future-looking view, and I'm actually going to start with a question from the audience. How feasible is the receivables market for long-term investment? Who on the panel would like to take this one?
My response to that is receivables funding is an asset class that's here to stay. It's a scalable, very interesting asset class. It gives corporate credit risk to investors. If you are an investor with a corporate credit risk slant to your portfolios, receivables, trade receivables, supply chain finance are absolutely an asset class that you should be looking at. It's not a flash in the pan. These are what have driven trade and industry for thousands of years. And it's a way that we now can use technology to give investors from other walks of life access in a scalable way to this asset class that's repeatable. You think about a company that's generating receivables, they're continually working and generating these cash flows. So my response here is it's much more sustainable, much more regular than perhaps just a corporate bond issuance that may come around once every 5 years or once every 3 years or what have you. This is a repeatable business flow that will keep going, therefore keep generating assets for investors.
But I totally agree with Steve in terms of the asset class, has been around for hundreds of years and it will continue to be. So no question there. I think the challenge is, and I'm not sure how the question, was meant to be asked in terms of if you say, how is it for a long-term investment? The challenge is the nature of the receivables themselves, because if you're a fixed rate investor and you want a 10-year exposure that's constant, it's not a great asset class. And that's some of the challenges we've had with some asset, investors, because people who want to buy into our programs who aren't banks, so we have a lot of volatility in sales, whether it's seasonal or, whatever, where, for these programs to be efficient for us, they need to go up and down fairly regularly. Otherwise, our cost of capital can get out of whack. And so if you're sort of an insurance company or somebody who says, I want a 10-year investment that's stable and not moving, it's tough to do. I mean, you can do it, but you need to access a whole host of originators in a sense to create a minimum asset balance. And then you have to do, in the old days, variable funding notes or something like that, where there's some investors like banks who can kind of deal with the volatility. But that's the challenge for me on the asset class. It's just it's not a long-term asset itself, so it makes it harder to package it up.
And if I could just add into that, so I'm mindful of time. There is the ability to use this trade finance technology and securitization technology to deliver, to Boz's point, longer duration assets. So, the beauty of having a broad corporate credit base is you can take various transactions, you can apply the different technologies to creating longer duration assets. By definition, the DNA may be shorter, and there will be things like infrastructure or other types of transactions that are by their nature longer duration, which follow the same sort of methodology. So the beautiful thing about trade finance, supply chain finance, asset receivables is you can tap into all the different funding strategies that asset managers will have. So I'll stop there. So.
No, thank you very much, Steve. And I guess in relation to that, Jerome, would you say there's been a convergence and maturity of products within trade and receivables securitization markets, be that from factoring techniques, receivables, discounting, off-balance sheet treatment, and securitization?
Yes, sure, and that's a perfect transition with what was just said. I think that there is a great evolution of our trade receivables ecosystem at the moment. There are various reasons for that. Obviously there is IT evolution. We are able to access the data. 10 years ago, it was pretty difficult to have access an easy way to the evolution of the books. So we provide a lot of comfort to investors also, but also a lot of comfort in the operational aspects for the originator. So that's one, and there are many market players helping in that process. The regulatory changes are also changing the situation because we are not in the same world as 10 years ago. So there is probably more room for other investors than traditional banks or factoring companies to join the market and to help fill some gaps in this process. And we are in a low investment interest rate environment for years. It has also an impact. So there has been new players, a lot of new players coming, a lot of new investors also. And I think it's very important because it changes things for the traditional trade receivables financing providers, in the sense that what we do fundamentally is very basic. We purchase receivables, and vis-a-vis our corporate clients, we need to deliver a given price, a commitment, a size, and that's it. And the way you do it, either through supply chain financing, factoring, alternative fund, fintech, or securitization, at the end of the day, for these guys, it's the same. So where and that's a link with the question just before, where I believe that we are maturing, and I think securitization techniques notably can help in that process, is that we need to repackage, be more agnostic about the products themselves in the first place in order to make sure that we apply the right techniques in order to maximize the benefit for the chain. I believe securitization from that perspective is the right tool for many aspects. There are other tools in the supply chain world. I believe that there might be some other stuff might be considered, but we are maturing, and I think for all the reasons I mentioned, I think we need to, and traditional providers are also forced to consider things differently because we are used to our franchise, we are used to pre-existing products. And I think it's very interesting to me now because the products are combined differently, and I'm a strong believer in the complementarity of the solutions that are offered. Knowing that at the end of the day, I think somewhere in the chain there is a place anyway for securitization.
Thanks, Jerome. Jeremy, taking a forward-looking view, what are the anticipated trends you see on the horizon, be that Brexit or the LIBOR transition, etc.?
Well, I certainly don't have a crystal ball. I think my fancy football team is good evidence of that. But clearly there are some items coming up on the agenda that are going to need to be addressed in transactions. And Deepesh, thanks, you've highlighted some of those. So, Brexit, we're still not sure exactly what the terms are going to be, how it's going to look like, but clearly it will have an impact on how trade is done. And there are other kind of structural elements that may follow as a result. So particularly for STS transactions, we may end up with kind of separate UK transactions from other European transactions. On the LIBOR side, just addressing the move from an essentially kind of forward-looking rate to a backward-looking rate is a challenge that the market generally is grappling with. I think relative to other sectors, trade receivables probably have it slightly easier in that interest on underlying is less of an issue, and transactions don't tend to have derivatives with the kind of associated complications there. But certainly it's something that market participants are considering at the moment. And really at the moment, the key issue tends to be, do we want to lock something in now, or do we want to build in a mechanism so that we can address that in the future? Some of the other kind of key trends that spring to mind are just ways people are positioning themselves in case there is an economic downturn. And some of the points that Robert was mentioning earlier about kind of increased credit enhancement, increased credit insurance, are certainly kind of structural techniques that can be built in there. And then I think also that there is a trend towards greater use of technology, and it's kind of linked to the various points that the panelists have made about the kind of increased interest in this market. I think a big factor in that is the fact that there's much more data around, and many providers who can help with kind of tracking receivables all through the process. And as a result, people can make some more informed decisions. And I can only see that increasing. And as a result, more investors are looking at this asset class because of the reasons that we've all discussed. They're viewing it, particularly in certain sectors, as a very robust and sound investment, even for the long term. And also actually on the kind of originator side, increasingly we're seeing corporates that hadn't really considered this type of financing as a useful tool to add to their portfolio of tools. We're seeing certainly private equity houses who are looking at this as a really sensible way to increase the value of their portfolio companies. So overall, I think the increase of tech will really help that, and it should be a really good time for the market.
Thanks, Jeremy. And final question, Robert, in relation to securitization, how has the investor base changed as a result of the pandemic, pre, during, and post-COVID? And how are alternative sources of capital accessing this asset class?
So I think on the securitization front, I would say, the investor base hasn't really changed much vis-a-vis the pandemic. I mean, you still have the banks in there at the senior positions, the other equity or private equity or funds playing in the measure equity. I think what is interesting is, and it's kind of more on the factoring side, where when we started running up against the reduction in the aviation risk sector, or appetite for risk that I mentioned earlier, we did go out to a number of funds to see about selling the risk to them, and there was appetite. But what we found is, and we found this as well when we looked at selling mezz and equity pieces on some of our securitizations, is it's just this. There still seems to me to be a gap between the bank pricing and what the funds demand, because when you go out and say to a fund, I've got this exposure to sell, and they say they want to buy it. When they put their pricing on, a lot of them have minimum return requirements, and they can't adjust for the fact that a 90-day receivable is a lot different than a 3-year bond in terms of your risk profile. And you should, price it accordingly. You can stop buying receivables on a revolving basis whenever you want, with 90 days notice effectively, or if you're sitting on a bond, you're going to sell it at a big mark-to-market loss if things go bad. And so what happens is you talk to people, and there's a lot of talk, and I've seen a number of funds created to try and get into this space. They think they can compete with the banks, whether it's on single names or in the senior positions, and they can't because their pricing is just expectations are too wide. So the only place I really see the quote alternative investors playing is if they're buying an equity piece or maybe a mezz piece, and they effectively get leverage on it from the banks taking the senior funding position, and then they can hit an 8% return requirement. But even then, when you get into that space, the challenge is if you're an issuer and you have volatility, like I mentioned, you want your equity and mezz to go up and down the way your senior does, because if you don't, if you get a couple of months where volumes are low, your weighted average cost of capital goes through the roof, because the equity position is now representing, call it 20% of your outstanding funding, versus when it's fully utilized, it should be 5%. So there are things that will be dealt with and can be dealt with. I think the point about technology is really helpful, because funds hopefully will have the ability to go up and down better as a result of that. But I still think there's a gap there between a lot of the talk about funds coming in, and there are places for funds, higher risk and things like that. but the banks still have really the big chunk of the market, and given their low funding costs and their lower return on capital requirements.
Thanks, Robert. So I guess very conscious of time now, just a few minutes to go. So we're going to conclude this panel session with one final quickfire question to all of the panel. What are your future-looking views for the state of trade and receivables finance, and where is the growth going to come from in the next 2 years? Jeremy, I'm going to start with you.
So I think partly people who have programs looking to expand them, so looking to add jurisdictions, if a deal's working well, it makes sense. And also from new entrants. So I mentioned before private equity. I think that's going to be a big trend in the sector.
Jerome, over to you.
I think it's pretty much around the themes we have been discussing during this panel. I mean, the ecosystem is evolving. I see a growing interest from corporates and also the facilitation of accessing medium-term or small corporates through a variety of new finance providers that will in turn use securitization to refinance not only their transaction but their book as a whole. And that's back to the point Stephen made earlier during this call. So I believe there is a matter of organizing the chain differently. We are able, so banks by definition are more focused on medium and large corporates. I think there is some space for development in the smaller corporates or SMEs. We need some intermediaries to do that, and I think we can deploy more because of technology, because of newcomers, because of the interest of investors. We can build new structures and serve differently the economy moving forward. I think for the large corporates, things are on track, tested and efficient. But there is potential for other clients.
Thank you. Steve.
Sure, just very quickly. I think that we'll see in the trade finance sector new jurisdictions opening up, such as China, India, LATAM, that lend themselves to growth. From an industry perspective, new industries adopting trade finance as a funding strategy. In the investor market, bringing in new investors to look at participating in the asset class and adopting supply chain finance, trade finance as an investment strategy. And then finally, I would say that tech will play an ever-increasing role within the sector for us, such as data-driven asset generation for portfolio approaches.
Thank you very much. And finally, Robert, over to you.
Sure. I think to me the most interesting thing is the tech and digital developments. I mean, it seems like there's dozens of players trying to get into this space with technology, whether it's through electronic invoicing or software, treasury or accounting software, and there's lots of them, and they're not all going to survive. It's kind of like, for any sort of tech business, where's the consolidation going to come, and who are going to be the 4 or 5 players that really make a difference? But it's clearly, I agree with Steve that the tech part that you just mentioned is going to be the thing that moves it. It already is, but it's really going to be who are the winners going to be for me to say.
Thank you very much, Robert. So we're out of time, but Jeremy, Steve, Robert, Jerome, thank you very much for an excellent panel session. Lewis, back over to you.
Thank you, Dipesh, and thank you to the panel. That was an incredible discussion. I hope everyone has enjoyed this panel and enjoys the rest of the conference. Thank you again to the panel, and goodbye.